These are visuals that you must have seen many times. The ringing of this bell changes the status of a company from a private limited company into a public listed one, which means anyone from the public can now bid and buy the stock of this company.
But you can buy these stocks even before they get listed, or rather apply to buy. And how do you do that? You do it by investing in the initial public offering or the IPO of a company. Let me take you through this process.
Once a company gets all the regulatory approvals to launch its IPO, it comes out with its IPO prospectus, which is a detailed document about the company. It aims to introduce the company to its potential investors, details its finances, its track record, and its future plans. It is also mandated to contain full disclosure about any potential liabilities of the company, including those under litigation.
Once you decide on the IPO you want to subscribe to, you will need an application form such as this. This form is available online with your broker or even your banker. Every application form has to be set for a minimum number of shares, which you need to submit along with a check for the total amount of shares that you are applying for. In case the number of shares allotted to you is less than the number of shares that you had applied for, the remaining amount will be refunded to you. Remember, you do need a demat account for this.
But why should you opt to invest in an IPO rather than buy the shares after they are listed? Companies are usually fairly valued in their IPOs and are available at a discount to retail investors, but getting an allotment of shares in IPOs for retail investors is usually not that simple, especially for companies with good fundamentals, as the IPO tends to get more demand than the number of shares that are actually on sale. In this case, shares are allotted on a pro rata basis, or lots are drawn and only few retail investors get shares allotted to them.
Typically, the merchant bankers who advise the companies, they would look at the traditional valuation models, and they would also look at the current market mood and the peer group. And based upon these factors, the merchant bankers would do then some pre-IPO marketing, talk to some institutional investors, get a sense of their comfort with the price levels, and then finally announce a price band. After consultation with some institutional investors through pre-IPO roadshows, price is finally discovered and then announced to the market. An IPO can be either for fresh capital, which is basically raising money for the company, or it could also be in a company where the existing shareholders are doing a divestment, where no capital is coming into the company, but the proceeds of the issue go to the selling shareholders. That is an offer for sale, a pure offer for sale. So a company which is already listed through an IPO also has an option of doing a follow-on public offering, basically which means that you are inviting public at large to again come and invest in that company's shares. So a follow-on public offering can be either again for raising of capital, fresh capital, or it could be a divestment from an existing shareholder where the company is already listed. For example, there are cases of Government of India companies, PSUs. The government may divest 5%, 10% stake in an already listed company. I've been telling all small investors who come and approach me is that IPO is the riskiest form of investing in equity. If you want to invest in equity, it is better to research, understand and buy an already listed stocks, because there is a lot of disclosures already about that company. The price has been discovered by the market collectively. In IPO, as we know, nothing is known about the company except through the offer document. An offer document is typically a seller's offer document. Number two, there is no validation by the market of the price, and therefore you are at sea about how good or bad the price is. Nevertheless, IPOs are a good investment opportunity. There have been hundreds of IPOs which have given huge returns to investors, and therefore try to read as much in the prospectus and from other sources to know more about the promoter and his company, his track record, his compliances. Has he been convicted for any crime or any offense? But if institutions have supported the IPO significantly, in case there is a huge oversubscription in the QIB portion, then the retail investors can ride on the back of the diligence both on the company and the pricing done by the institutional investors. For a retail investor, it is good for him to look at the QIB book and the levels of subscription before he takes a final call on applying.